All right. Welcome, everyone. Hope everyone can hear me. Welcome to the Monday Asset Management Zoom. Let me stop sharing for a bit. Okay.
Yes, I can hear you.
Awesome, thank
Hello.
you. Okay, just admitting a few more people into the room. Welcome, guys. It's Asset Management Mondays, and we have an amazing guest who's here. If there's anyone that is either new to the Freedom Chasers or this is your first time on this Zoom, the Asset Management series, do you want to indicate that in the chat? And yes, that goes for you too, Clark. Tell us where you're from. Put on my glasses to see what people are saying. Ooh, hey Mahmood, welcome. And Ilan, welcome. Thank you for joining us. So this is the Multifamily Freedom Chasers platform, and it's an ecosystem that was put together about 2 years ago at this point. Initial intent was to show 9-to-5ers and those who aren't as well, that financial freedom through apartment investing is, it's within our grasp, it's within our reach. And so we have different types of programming that's available for our community on Mondays. Oh, hi, Chelsea, all the way from California. Awesome. Thank you, Ray and Bernice from Maryland. Welcome. And oh yeah, Mahmoud, you're from Texas. I feel everyone's always from Texas or California. Hi, Deanna, welcome. Thank you for calling in from San Francisco Bay. Awesome. And Phoenix. Why is everybody from the warm parts of the country? This is kind of wrong. Um, I'm in Massachusetts. But the Freedom Chasers was, it was born out of this need to show working professionals like me, like you, that, financial freedom is attainable through apartment investing. And so on Mondays, we alternate. There's an asset management series. That's what we're having today. And there's a bit of a change in the schedule. So this month, we'll have asset management today. We'll also have asset management chronologically next week. So when we say next week, we mean really next week, next week, the 18th. We'll have another asset management series, and then we'll have an activation Zoom at the end of the month when Michael Blanc will be here. On Wednesdays, we have either a debt market update with our debt broker family, Jerry and Shelley Miles, or we do a broker call / napkin underwriting Zoom. So that's the type of programming that we have. So if you're here and you didn't realize that you were going to be having the asset management series, we're so glad you came, so glad you stopped by, and we hope you'll come again. So, Miss Ofiri, are you in the room?
Yes, I am. Can you see
Okay.
me?
Uh, oh, I was talking to Bibi. Sorry, I was referring to her as
Oh,
Miss
I thought you said Finney.
because she was arriving fashionably late. This is not how we welcome a guest. Clark, we'll get to you in half
You're
a
okay.
second.
Don't worry about me.
Yes,
All
I'm
right.
here, Bibi.
All right, hold on one second. It was hard to find you. You kept going in
Yes,
and
I'm
out.
here. I'm so sorry.
No, it's okay.
I'm having technical issues.
Uh-huh. All right. There we go. There we go. All right. Awesome. So let me share my screen very briefly. I think I kind of went over um, just the usual housekeeping. So today I'll have Bibi introduce our special guest, but today, as advertised, we will be reviewing loan broker strategies for thriving in multifamily asset management, because this is an asset management Zoom. And for those who may not know who we are, Bibi and I are both moms. We're both real estate investors. She's had over a 12-year run at this point in asset management. She's in the Dallas area. I'm in Massachusetts, where we get 1 week of summer. I'm newer in multifamily investing. I'm also a pharmacist, so that's kind of who we are. And we can be reached through email, social media. Those are our handles, and I'll later put them in the chat, so you don't need to worry about chasing them down. The Freedom Chasers community exists on Facebook. All of the Zooms we have, they stream on Spotify, and then there's also a WhatsApp group. Some people are not always on Facebook. It's easier to chat through WhatsApp, so I'll put the link to this as well in the chat. So if you're not able to take a screenshot at this point, that's fine. Alrighty. All right, let me stop sharing. You know how my thing has intermittent seizures every once in a while. So, all right, let me find our special guest. And Bibi, while I'm doing that, you want to introduce him?
Yes.
All right.
Hello, everyone. Can you guys hear me well?
Yeah, I would say there's a little bit of an echo though.
I just got a new mic, so let me announce. So, okay, we have Clark Finney in our midst. I'm going to just tell you guys a little story about how I met Clark Finney. Remember when I said most of the people I've worked with, my team members are actually from referrals, from maybe a broker or something, and that's how I created my team. So a broker referred me to Clark. Our first meeting was not good. And I'm happy that somebody spoke to me, and myself and Clark decided to work together. And ever since then, it's been an amazing journey. Clark is someone that I don't think I can use any other broker that is in the market I am. I don't think I can use any other broker, truth be told.
He's not kidding, Clark. I've tried.
Clark, I'm going to report Ify to you. Ify has been trying to get me to work with other brokers, but I said, you don't understand the kind of services Clark offers to us. It's gone beyond just the regular brokerage. And we're going to discuss all this today. And for you to know the importance of having a Clark in your team, it's very crucial. You can't overemphasize the importance of having a Clark on your team. And I'm really proud to have him with us today. And we're going to ask him. It's going to be a very interactive time. We're going to ask him some few questions. But before we start, Clark, can you just briefly introduce yourself to the house?
Yes, I can. Thank you very much, Bibi, for the great introduction. Honestly, I thought all of our interactions have been great. I never knew
Yeah.
that our first one didn't go so well, but I'm
Yes,
glad
me
the
too.
rest of them did.
Yes. Remember, I didn't want to work with you anymore because you're asking me for too many documents. I was like, I'm done. I can't do this anymore.
You know, I have been told that I can be a little tough sometimes, but
Yeah.
it's because I take it all very seriously. And so at least you know that although I can sometimes be a little rough around the edges, it's me coming from a place of professionalism and honesty.
Correct. Yes.
Ultimately, really just caring about trying to get this job done to the highest possible, um, quality.
Mhm.
So, we keep each other honest, but ultimately we both know that, from our experiences together, it gets the deal done. So,
Yes,
that's all that matters, right?
that's all.
Good, good. So a little bit about me. I think you guys have some great questions. If you're okay with it as well, I have a very quick, like 5-minute presentation too, just to kind of give an idea of what the economy is looking like right now.
Yes.
With some great insight over the timing of the market and how it's a
Mhm.
benefit to you guys. But to kind of begin, uh, my name is Clark Finney. I'm a loan broker at Matthews Capital Markets based here in Dallas, Texas. We have 16 offices nationwide. I run the capital markets effectively for the entire country. So whether or not you're in the West Coast or East Coast or Southeast, Sun Belt, Texas, Midwest, if you have any financing needs or equity needs, I'm only one phone call away to be able to assist you and put you in touch with local brokers or myself. Bibi and I've done deals, and where we've done a deal in Pennsylvania. I've done deals in I think probably more states than I haven't done deals. Um, but essentially, my background was working and starting as an underwriter at Freddie Mac for their conventional multifamily team in the central region of the United States. So think basically the central time zone. My team focused on deal inflows of about over $6.5 billion worth of loans a year. So definitely cut my teeth learning underwriting and how to get things done, doing it that way. And then fast forward, I grew tired of working effectively for the government, and so went to the private side to do it my way. And we've been doing it ever since, successfully in good markets and in bad markets. And in a market like this, it's kind of somewhere in between.
Mhm.
But I think we're all a little bit optimistic. Given what we've been through, I think we will be rewarded for our patience. Um, I know BB will for sure, certainly.
Yes. Yes.
Um, if it was easy, everybody would do it, right?
If it was.
And so it takes a very special person to get into commercial real estate in general, investing in general. But those few that do it and take it seriously can definitely be rewarded, as I said before. So without any delay here, I'll kind of want to show you guys a few things I put together from a meeting I was in today.
Mhm.
Thought that you guys could get some benefit from it. And then we
While
can,
you're pulling that up, Clark,
what's up?
in terms of your contact info that I'd like to share, would it be just your email or what else would you like us to share about how people can reach you?
That's a great question. Email, phone, text message, um, however you want to get a hold of me, I'll be responsive. And whether
Okay.
you're, uh, and don't be intimidated if you're working on your first 10-unit deal, or if it's a 1,000-unit portfolio. Effectively, I can give and spend time talking with you and giving you the best advice I possibly can, because I love what I do. I think I have the best job in the world. Some days are easier than others, but I think I have the best job in the world. All right, so let me share my screen here with you guys.
Yes. Just go ahead.
I think this is probably the best one. Can you all see this?
No. Yes, right.
Yep, it's loading.
Slowing, yeah.
Perfect. Okay. Are we all good?
Mhm.
Wonderful. Okay, so it's 8 slides. It's fairly easy. I think what everyone's probably heard about 100 times in the last year is CPI, right? That's the whole reason why rates were increased, and CPI will be the reason why rates will eventually get cut. CPI has always been a function of our economy, right? Of course, during COVID, a lot of government stimulus and effectively zero cost of capital.
Sorry, Clark, before you continue, what is CPI? So they know.
Consumer Price Index.
Yes.
Consumer Price Index effectively is a survey that the government puts out and asks people, hey, what does a gallon of milk cost? What does a gallon of gasoline cost in your area? What does your car insurance cost? What does your rent cost? All of this comes together in the form of one monthly CPI report that kind of puts a gauge on where all those costs are today versus where they were this time, last year, right? And so this report or this graph basically shows the cumulative data points since January 2004 and where we are as of January 2024 at 3.1%. Now, what's interesting is that the federal or the Fed, who is in charge of increasing and decreasing the costs of the funds rate, has said that their target is 2%. I think we've all kind of heard that. They will not cut rates until they can get close to or hit 2%. We've kind of been floating for the last few months in this 3.1% range. It's actually kind of interesting over the last 3 months. If we hit 3.1% tomorrow, which is when the next CPI report comes out, it'll effectively be the 4th time in the last 5 months that we've been at 3.1%. Now, obviously it's not 2%, which is what we all want because we want those rates to get cut. But 3.1% is certainly better than 5%, which is certainly better than 9%, which is where it was not too long ago at the peak. So to put it in perspective here, 3.1% is what the target is tomorrow, but 2% is where they want to be in order to cut rates. There's this amazing tool on the internet called the CME Fed Watch tool. I like to call it the Vegas odds. It's essentially the forward curve or probabilities of Fed rate cuts between now and the next 2 years or so. So this is a snapshot as of today. Today we are at this end of the Fed funds rate. So there is right now a 76% chance as of May that rates will remain the same. However, in the June meeting, there's a 60% chance that they're going to cut rates for the first time by 25 bips. You can kind of follow these blues to see that there's probably 1, 2, 3, 4, 5, maybe 5 rate cuts between now and 2025, which would be pretty interesting. Now, what does that mean for your loans? The interesting part is that some people would believe that if they cut rates by 25 bips or 0.25%, all of the loans that you get will immediately be 0.25% less. But that's not necessarily true. Right now, where we are today is at around 4%. And this number has all of those future rate cuts that we saw here priced in. So that's why the Fed and their commentary and them extending and pushing their rate cuts back further and further and further has caused a lot of volatility recently in the markets. Because every time at this point in time, knowing everything we know today, which is that they're going to start cutting rates in June, we're going to price the Treasury at 4%. Now, there was a point in time at the end of 2023 before a few CPI reports came out that they thought that they were going to already have had to cut rates, and they didn't, because more CPI information came out hotter than expected, and so the treasuries went back up. However, it appears that we are in a moment of stability, especially if we can hit 3.1% tomorrow. So everybody at 7:30 in the morning, wake up, get on your phones and figure out what CPI was, because if it hits 3.1%, we're going to be in a very good place. I think this is probably the most relevant slide for you guys. As multifamily investors, this is the only row that you need to be concerned with. Okay. This is effectively at a snapshot of January 2024 of $22.6 billion worth of commercial real estate transactions. This kind of puts a frame of reference of where values and transaction activity are compared to this time last year. So again, this is all you need to worry about, but here's really what it all means. As of this time last year, transaction volume is 60% down. As of this time in January of last year, transaction volume is only 45% down. So that means it's actually picking back up between the last 12 months and January of last year. Now, what does that mean for you guys in the frame of reference of value, right? From a year-over-year change, values have gone down, right? With the average cap rate for apartments, this is all Class C, B, and A, being roughly 5.3%. So what does this all mean for you guys? Obviously, transaction activity is low, and values have decreased. However, if you look at this graph right here, this is all the value of commercial real estate since 1998. And what we're realizing here is a true correction in values that we haven't seen since about 2014, which I think is an excellent opportunity for you guys to take basis in, multifamily, retail, hotel, whatever it is that you're interested in investing in, because right now you have the ability to pick up a basis that some people that have been investing since 2014 have had, right? It's not an easy market. It certainly isn't a stable market, but for those of you that are persistent and patient, you will, as I said, be rewarded by entering in one of the most difficult markets we've had easily in the last 10 years. Because right now, if I told you that you could buy something at a 2014 value, would you say that that was a bad idea? Or would you have said that I would have appreciated that, knowing that a long time ago? Does that make sense? This is kind of what I'm talking about. You see all this volatility. I don't know if you can see my cursor. The spikes up and down, up and down, up and down, up and down.
Mm-hmm.
That is incredibly difficult to navigate, because as I'm going to speak about a little bit later, is that your value of what you're going to buy a property for varies based off of the cost of capital, right? So if you're going to have a 6% interest rate, then you want at least a 6% cap rate, right? Well, if your 6% interest rate is changing from 6% to 6.5% to 6.75% to 7% to 6% to 6.5% to 6.75% down to 6%. Well, it's very hard to put a value on anything, which is one of the things that make this last 18 months so very difficult. But hopefully this gives you a frame of reference that although interest rates have always been high, especially looking at since the 80s, people have been buying and investing in multifamily and hospitality and retail since since forever, really since commercial mortgage-backed securities started in the 80s. Investing in, from the institutional standpoint, commercial real estate boomed. And so people are finding ways to invest in multifamily with interest rates that were double what they are today. And all they're saying to me is that your basis has continued to improve between the last 10 years, or since at least 2000 and today, even with the Great Recession, even with COVID. The difference of being at 120 today versus 60 in 2000 is almost a 10, 20, 30% different in values, right? So I think that's important for everyone to kind of realize. And I know that that's probably a lot to throw at you, but with all that being said, definitely open to answering any questions you may have.
Yeah, so Clark, thank you for starting up with this, because some of the questions I wanted to ask you is somewhere around this as well. So given the challenges and the trends you just showed to us, how would you advise that we navigate this from your own perspective? How do investors navigate all these different challenges? Because you've shown us the CPI, you've shown us the interest rate, you've shown us trends that have been happening and all that. What do we do at this point as investors?
That's a great question. That's an excellent question. And I mean, the reason why volatility has been so high and it's been so difficult is part of the reason why across the board, all transaction activity is at, a 10-year low. Because how do you put a value on it in this volatility? And the answer is by at least trying to take out as many variables in the execution as you possibly can, right? First and foremost, what a lot of people are doing are asking for a very large spread between what their cost of capital interest rate is versus what the cap rate is, right? Well, that in lies the key challenge in all of this, because from your perspective as a buyer, if you have a 6% interest rate, you want at least a 6.5 cap rate, right? Well, if you're a seller and you bought it at a 4 cap in 2021, or you have your basis at a 5% cap, and someone's saying that they'll buy your asset from you at a 6.5 cap, there's obviously going to be a disagreement in deferring values of opinion on the commercial real estate price, right? And herein lies why transaction activity is low. How you guys can navigate this today is by finding something that index locks or rate locks at application, right? Bibi, you and I have discussed this at length many, many times, finding something that when you sign up a loan, when you agree upon a value that you guys will go into a contract with, if you can keep your 6% and rate lock at application so it stays at 6% through the life of the loan between signing it up and closing, then that is one massive variable that you're taking off the table to increase the certainty of your execution and the returns for your investors. So that would be my biggest piece of advice. Is a financial tool or a loan product that rate locks the application. This can be an agency loan, this can be a bank loan, this can be a credit union loan. There's dozens of varieties of different loans to choose from, but that would be my biggest piece of advice of what to target.
Yes, okay, but in a situation whereby, like for example, we had to pivot from one agency loan to another on one of our deals at some point due to requirements from the initial lender. What would you advise people to do? Because at that point, remember we locked our rates, but because we had to pivot, we lost that interest rate.
Right.
What would you advise people to do if they see themselves in that situation? Can anything be done actually at that point?
To continue to extend the rate lock that you were already in? No, because what I think all lenders that would rate lock an application do in order to mitigate, lack of execution would be to say, hey, we're going to rate lock this deal for you for the next 60 or 90 days. We expect, you expect us to do our job to close the loan for you. And in turn, we expect you guys to get to a point to where you're ready to get this deal closed in 90 or 60 days. That one was a very unique situation that wasn't necessarily the fault of your team, but also a very difficult seller who receiving diligence from, although we were able to get the deal closed, I think even at a lower rate than when we started because of the volatility. Sometimes there's nothing you can do about that. And, ultimately what we did was pivot from something where we believed that we were in a high interest rate or peak in the rates in between us being at that point from dropping the product, that rate locked application, to us being at that moment making the switch to close, rates were going to go down until we rate locked. And that's, I think, exactly what rates did. They went down from that moment of pivoting. Instead of us locking again at a higher rate, we followed the index down and actually closed at the lower rate than when we started.
Yeah, so I'm, yeah, thank you so much, Clark, for that. So I'm going to, because we have some people that will be asking questions as well. I'm going to quickly dive into underwriting based on the rate lock. Some of the things I do during my underwriting is when I call you and I ask you, oh, Clark, what's the rate for today? And you say, okay, let's say the rate is 5.5 and all that. What I do in my underwriting is I put it at 6%. Or 6.2%. In case anything happens, we can withstand and withstand all that. So my question to you is, how do you help people navigate the underwriting process? And what factors are crucial in securing favorable loan terms for a multifamily?
That is one of the techniques that you use, Bibi, when you're offering on a property where you put your rate 50 bips higher than what the market is at that time, is a very good idea. Because and I think it also provides a lot of strength to your offer too, because what I think everybody in this market and industry has experienced, if you've been active in this last 24 months, is that rates change, and when rates change, so do people's opinions on the values. And if you guys have your rate 50 bips higher, and that's where your value is, if the rate moves 50 bips higher between then and close, then you're still, the numbers still work on your side, right?
Yeah.
Otherwise, the person that they chose instead of you that was looking at the value at that moment in time, would be asking for a retrade very likely. And so that's an amazing thing that you use. One of the other, what was the second part of your question? I apologize.
I said, what factors are crucial in securing favorable loans for a multifamily? Because I know there's a time you said the team also matters, the team that you're bringing.
Right.
Yeah.
Right. Okay. Yes. I would say in kind of 3 bullet points, when you're securing any kind of commercial real estate loan. Number 1 is location. Okay. What market are you in, and what market is the property in? Right? If you are in Dallas, Texas, for example, and you're buying a property in the middle of the woods in Oregon, and you have no access to that market, but you just like the deal, it's going to be very difficult for you to be able to buy that asset, right? It's going to be very difficult for you to convince a lender that you're going to be on site all the time and actively managing your deal, right? If you live in Dallas, Texas, and you're buying a deal in Dallas, Texas, which is also a very large market, you're going to have much more success getting strong financing on that because you're close to it and you're buying in a strong market. So that's number 1 in my personal opinion. Number 2 is experience, right? And not just experience for yourself. It doesn't necessarily have to be your experience. It can be the experience of the team, the people that you surround yourself with, because effectively, your team's profile is what gets you qualified for financing, right? That's what teamwork makes the dream work. That's super corny, but it's very much real. And then 3 is financial strength. I have seen people that are very experienced, but do not have very strong liquidity or financial strength, and it's difficult for them to be able to get financing. I've seen people that have a lot of financial strength and not a lot of experience, and have been able to receive pretty good financing terms. And so, but it is my third point, because overall, I think that if you have a great property that's close to where your team is, and your team has some material level of management and operating experience, and you guys may not be financially the strongest, but you have at least 2 of these 3, you'll be able to get a good loan. And so location, experience, strength, that's what I would say.
Awesome.
If you
Can I
can chime
actually
in,
walk
yeah.
a, yeah, can I walk the line of questioning back a bit because we have a variety of audience members who may be at different stages of their multifamily journey. So from a very basic level, Clark, you know, you kind of alluded to different loan products, but what kind of loan products do you actually offer? I'll start with that and then I have a follow-up to that.
Sure, absolutely. So, to kind of conceptualize it, you want to look at it in the frame of it being into kind of two different doors, right? Door number one is a permanent loan, and door number two is a bridge loan. A permanent loan size is based off of in-place cash flow, right? A bridge loan will size to a pro forma, a function of where the value is today versus where the value will be in 18, 24, 36 months. A permanent loan is 5 to 10 years in term. A perm or a bridge loan is 12 to 36 months in initial term with some extension options. Within those two doors is an entire library of different products that you can use, whether it's bank, credit union, government agency, conduit, debt fund, um, you know, life insurance company, sovereign wealth fund, private wealth management companies. I mean, all of these, there's an immense amount of capital out there. And the concept of being able to invest in commercial real estate extends beyond your personal investment. There's so much of the United States, this country, and the world's wealth that's in commercial real estate. And so by wanting them to be so attracted to it and active in it, there's constantly new ways for investing in real estate, whether it's from the principal side, which is all of you, or the debt side, which is all the ivory towers in LA, Miami, New York, and Boston, and Chicago, and Dallas. So, but to put it into perm and bridge.
Okay. I might get to bridge a little bit later because that definitely as a whole has taken a bit of a bad rap with recent happenings in the commercial multifamily space. But so say I come to you, Clark. What exactly do you offer in terms of the relationships you have with different lenders? So I presuppose that you have access to different lenders. What does that look like? What does the process look like if I came to you with a deal? How do you find the best product or lender for me?
That's a great question. So I actually thank you for sending me some of these questions in advance because they really made me think. I looked at my intranet or Rolodex of lenders today, actually, and from the permanent side, I think I had over 600 permanent lenders from across the United States. On the bridge side, I had over 380. And on the equity side, I had 150 equity groups, right? The way that you match and what my entire role is when you really boil it down is matching lender profiles to borrower profiles, right? And that's in four, really three, but number one, deal size, right? Are you doing $1 million deal or are you doing a $10 million deal? There are lenders that only play in certain sizes. So that's, that takes 500 lenders down to 300 lenders, right? Deal location. Is the deal in Tampa, Florida, or is it in Los Angeles? That takes the 300 lenders down to 150 lenders, right? Borrower profile. Is this a highly, aggressive group, or is this a fairly, conservative group? If they're aggressive, then we're going to find a group that, obviously will underwrite aggressively, right? Maybe somebody that would underwrite more on a pro forma basis. Are they a group that are long-term holders that hold for 10 years and never refinance and never touch it? Those questions bring the 150 lenders down to probably 50 lenders, a quite dramatic, drop off. And then for those last 50 lenders that you'll use to quote one deal, it's borrower expectations. Do borrowers want rate locks at app? Do borrowers want non-recourse? Do borrowers want a lot of leverage? Do they want a group that they can continue to grow with, or do they want them just for this one single transaction? All of that holistically kind of brings that last 50 lenders into probably, I personally do not like sending deals out to more than maybe 8 to a dozen lenders. In a more stable market, probably less than 10 is really all you need to get the deal done. The only reason why I would send it to a dozen would be it's so fluid in this market that there's sometimes where lenders are, hey, we were active yesterday, but we're not active anymore today. Or, hey, we actually changed our loan amount minimum from 5 million to 15 for whatever reason, right? So, again, that's kind of how you synthesize a lender list of 15 boiled down from, over 500 choices.
Awesome. I'll just throw this comment in there, and Bibi, you can ask your next question. This question was kind of important to me because I was trying to be, let me just say, exceptionally prudent with finances. And so there was a time during one of the deals we were looking at, I kept telling Bibi, I think it'll be cheaper if we just went directly with the lender. But based on all you've described, yes, I was trying to steer Bibi away. Based on all you've described, there's no way a team could have this depth of reach that you have and do all these presentations, etc. So the reason I'm bringing this up to the group is because yes, you will pay a broker, a debt broker, a fee, but they are doing so much more behind the scenes that you just won't be able to do. So
So glad that you brought that up.
yeah.
That's my favorite part of it's like, how do you earn your fee? And the reality is that it's almost a small investment in your own returns. Because the reality is that if you go yourself and just randomly, call every bank that's in the market that you want to buy a deal in, they're going to give you this kind of pricing that they give people that they've only spoken to for the first time, maybe. Maybe they give you the best deal in the whole world, but usually it's and it's probably the first time they've ever spoken to you. And usually if you just call off of Google, you don't really know if you're speaking to the right person, right? But effectively, if you find a 7% rate on a 25-year AM, you're going to be paying 20% more in interest if I have a 6.5% rate on a 30-year AM, right? And so that 1% of the loan amount fee can quickly pay for itself by simply just putting you in a better product, right? And then, moreover, if anything hits the fan, which Bibi can attest, it almost always does. Yeah. Even in an easy market, something always happens, right? It's important that you have someone on your team that literally does this full time for a living and has seen, I wouldn't say everything that can happen, but a lot of things happen horribly wrong. Because that's how this business is. If it was easy, everybody would do it. And it's not easy. Not a lot of people do it. And the people that stick around are psychos. I'm just kidding. But I mean, like you along the way learn a lot of things. And, what used to stress me out and keep me up at night is just another Wednesday now. And, let your anxiety be cured by my experience to understand what's going on, how to get to the bottom of it, probably have a relationship with the lender that's pretty candid and almost, friendly, because saying effectively a lot, but we develop from one business to business, lender to broker, almost social relationships to the point where I can call somebody when a deal is going wrong and say like, hey, buddy, I know you want X, Y, and Z. I know all this is going wrong, but like, how do we really get through this?
Yes. That reminds me, Clark. I remember when we were doing one of our deals, and because I really tell people there's a lot of benefit in using a loan broker or a debt broker. It just takes the weight off you. You taking your documents to different lenders. It's not just you taking your documents, there's a presentation. You have to package it well. And these are things a debt broker would do for you. I remember the conversation when we were having with a bank, a lender. We've never met the lender before, but Clark, I was in that meeting with Clark, and Clark did the entire presentation as if I understood the market more than him. I've done my market research and all that, but he went extensively. He did his own research. He did a presentation as if we both did the market research together, and he presented it to the lender, and the lender gave us, they said they were going to give us a what they call it, a quote on it there and then. So these are the benefits you get from using a debt broker. It just leaves the burden off you. I'm one person that likes to cut costs, but this is a cost I would not cut because it's worth it. Is really, really worth that effort and all that. So Clark, I want to ask you these questions for the sake of those that have never or are trying to get on board on all this. The question I want to ask you is, what are borrowers eligibility? What do you look out for in a borrower? I know you said it in a different way, but for example, if I come to you, Clark, I have a property I'm interested in buying. I have money. What are the documents you ask me to present? What are things that I should have before approaching you, aside the location, aside me having liquidity? What are things I should come with when coming to
Yeah,
Clark?
absolutely. That's a great question. And so one last thing about the brokers is your job and your role in the deal is managing investors' expectations, getting investors, doing all of the legal and operating agreements and all of that stuff, which is arguably the most difficult part of the entire transaction. You have enough to deal with, right? Like we will handle everything else, right? But from a perspective of like, hey, Clark, I like this property, X, Y, and Z. I have liquidity and, experience. What do you need in order to size a loan? Well, you have to keep in mind that it's a cash flowing asset sometimes. So I need everything to understand the cash flow, right? I need P&Ls current. I need a rent roll that's current, and a general idea of what you think about offering, right? If you have a pro forma of your own, a Michael Blank model, become extremely familiar with that model over the years, even better. Now I can kind of see where your head's at. But really, bare bones, all I need is a P&L, preferably a T12. So what that is that it's 12 months of operations broken out, by month over 1 year period, and a rent roll that has square footage, rents, lease starts, lease end dates. These are standard items that anybody who's selling an asset should have. And certainly to the point of this meeting, anybody that manages their asset and has good asset management should certainly have. Because the better you are at managing your asset, the higher value you'll receive as a seller, and the better returns you will receive if you're refinancing an asset, because you'll have good diligence in order to be able to get the best, most premium refinancing quotes. So it pays to be organized.
Okay, so after doing all that, let's assume you give us a quote, everything is fine, we went under contract and all that. What are the next steps for the investor? What would you be looking at for the investor to provide for you to give to the lender at that point?
Sure. So let's say, Bibi comes and says, hey, Clark, I just had an accepted LOI. I want, X, Y, and Z. I go, no problem. We'll figure that out. We'll get it done. We'll go and are you asking like the timeline of a deal? Like how long it takes to get the deal
No,
closed?
I'm asking investors due diligence, like their SREOs, their personal financial statements, those items.
Oh, sure. That's easy. your personal PFS or balance sheet, what is your liquidity? What is your net worth? An SREO, schedule of real estate owned, stuff with addresses, purchase prices, values, loan amounts. In a perfect world, we get all of that up front. Can't say I always do, right? Sometimes it's more of like hey, so I want to call today. I was like, so let's just, throw this out here. If you're trying to refinance out of this construction loan, that you own a $5 million asset, and you probably own a few more of it. So more of them. So let's just say yes or no, is your net worth less or more than $7.5 million? Do you have liquidity of, more or less of $250,000 to $500,000? That is not impossible to answer off the top of your head generally, right? Especially if you're in the profession of managing a portfolio of assets, right? It doesn't mean that I don't need a PFS or SREO at some point. I will help make it for you. Literally. I'll hold we have an entire transaction coordinating team. It's not just me. We have 2 lovely people on our team. I have 4 very, very smart associates. Together, it's not just me. It's the entire team that are here to put your PFS together, get on the phone and say, hey, how many assets do you own? Help me help you fill in some of these missing blanks here. And then I'll create your PFS if you need me to. I'll do that. But in order for me to even get quotes, I can make it as easy as like, hey, is your net worth X, Y, and Z? Is your liquidity X, Y, and Z? Yes, no. P&L, a rent roll, and a general idea of what your experience is. I can probably get you at least an LOI with that. I don't always love doing it that way, but I can do it.
Yeah.
And okay, I was about to ask, okay, so we get to that part. What currently, what rates have you been seeing when what should we be expecting? What loan to value ratios are out there right now? Should we be scared? Should we be sitting on the sidelines?
No, I don't think you guys should be sitting on the sidelines. And the reason why is because as soon as rates start getting cut in June, which is what we all think today, right? No one really knows when rates are going to get cut. All we can all guess is what they're going to do. But effectively, I don't know if I'm still sharing my screen, you're going to see a bottoming out in real estate values, right? And that's the optimal point to obviously get into an exit, buy low, sell high, right? Now, every day that passes, people question, have we reached the bottom of property values? And I think that probably doesn't happen for another, 3 to 6 months, the absolute rock bottom of it. But that doesn't mean that you wait until 6 months to start actively looking at investments, right? Understand what your expectations are, what's realistic, have an actual budget in mind as to like what your, group's, budget is. Are you guys looking for a $20 million deal? Or are you looking for a $2 million deal? Right. And what I would highly recommend is to go to and call commercial real estate agents in the multifamily profession, in the markets that you want to invest in. Bibi does a great job of this. Calling and introducing yourself and saying, hey, my name's Clark. I have 3 partners. We have, a pretty strong net worth and liquidity. We have experience in the market. We're looking for 100 units, properties that are, 70s vintage plus, and, looking for generally 6 caps. And I guarantee you in this market, you're going to have brokers that are going to take that note down and they're going to put it on a piece of paper and they're going to put it right next to their computer. And as soon as they find a deal that matches that profile, you're going to get an email. Okay. I guarantee it, because keep in mind that, I mean, I just showed you this graph, you know, transaction activity is in a 10 to 15 year low, right?
Mm.
You have a lot of borrowers, I mean, a lot of brokers, and the brokers that are still working are ones that are absolutely committed to being successful. And the ones that are still working that are successful are the ones that take good notes and that call you as soon as they find something that you could be interested in. So the best piece of advice I could possibly give you is to call your local brokers, introduce yourself, tell them exactly what you're doing, and almost have that rehearsed, because you really want to put a really good first impression on, to make sure that they take you seriously and send you, the good deals. And Bibi gets off market deals now.
Yes, I do.
That's
Bibi
true.
sees more off market deals than I do. I'm like, what the heck am I doing wrong? Like, I know all these guys. I know all the guys that are sitting
Yeah,
in
but
deals, and I don't.
they're not penciling out yet. You know that for a fact. Yes, they're off market deals, but we're not there yet still, Yeah, but
But
that's
you have to kiss a few frogs, right?
oh, we've kissed a lot, you know that. I remember then
Yeah.
trying to reach a broker was like, it was like you're calling God to come down, It was difficult to get a broker to even pick your call. But right now, things are getting pretty fair. I think people can reach out to brokers and start creating that relationship now, because once the interest rate goes down, then value of the property starts going up, and before you know it, they will become a mini god and you will not be able to reach them. So start creating those relationships right now. Clark, I have one more question before we jump into the to the audience. My
Sure.
question is, I have a phobia right now for bridge loan. Even if I know a bridge loan is going to make a deal work, and there's a very, very obvious or good path to exit, I still don't want to do it. So what is your advice on bridge loan at this point?
I have a great graph of this.
Okay.
Just give me 1 second, see if I can find it in the next 10 seconds. Here we are. Found it. Wonderful. Here we go. And saving this or sharing this screen here. There it is. And boom. You guys see this?
Mm-hmm.
Okay, great. So I think that, I don't know, between 2020 lockdown, shelter in place, no one's leaving their homes, the world's about to end. And then in the federal government cutting interest rates to zero in order to stimulate the economy, you had very, very affordable costs of capital. Because of that, obviously values went really high, because costs of capital were very low, and leverage was very, very high, and cap rates were very, very tight because values were high, and sizing to pro forma was very, very easy to do, right? Because if you're buying at a 3 cap, and everyone thinks in 3 years values are still going to be a 3 cap, which is ridiculous, the loan works, right? People were increasing rents 20% at every time that a tenant was up for renewal, and they were paying it because they were getting stimulus checks, right?
Mm-hmm.
Made all the sense. Well, here's what they didn't expect. In 2022, they were going to increase rates the fastest and by the most that they've ever done in United States history, right? Nobody knew that this was going to happen. Okay, the forward curve didn't know this was going to happen. No one really saw this coming, that they were going to take such an aggressive approach to fighting inflation by increasing rates by as much and as quickly as they did, right? And as a result of that, overnight, in 18 months, all of these loans that were sized on pro forma that were heavily leveraged, because no one thought that it was going to go from a 3 cap market to a 6 cap market in less than a year, all of these bridge loans, or most of them, found themselves over leveraged, right? And so when you buy a deal at a 3 cap, and now you turn around and wake up and your value is a 5.5 cap, there is 2.5% points in cap rate of value that you need to find somewhere, whether it's in rent growth, but probably not in rent growth. It probably just means you're over leveraged, and you have a hard time getting out of your bridge loan, which is what, I mean, it's not just happening to private retail investors, but it's also happening to institutional investors, right? It was like everyone was doing it. Everyone's doing it. It can't be wrong. Well, here's what I would say is the difference between going into a bridge loan now versus going into a bridge loan in 2021. Other than, you being in an obvious scenario where you are at the bottom of the interest rate market and expecting the interest rates to only go up, you are at the top of the interest rate market where even if they stay high, you at least know that you're at a basis in today's market, right? And realistically, whether they cut rates only once in the next 24 months or 5 times in the next year, there's a pretty good chance that rates are going to be at least not higher than where they are today. And so it makes that pro forma much easier to expect because what you're also valuing is the fact that you're buying a heavily corrected value by almost 20 to 30% in some markets, some deals. So from the perspective of buying an overpriced asset with very, very cheap floating rate debt and being on the other side of it, which is on this market, buying a heavily discounted asset on a floating rate index or fixed rate index that's already as high as it's ever going to go, really cuts a lot of the risk, in my personal opinion, of using that product, even though there are so many horror stories of people absolutely turning upside down as a result of that product. Does that make kind of conceptual sense?
Oh, yes, yes, because we're going from low to high. Before now it was high to low. Yeah, it does make sense. Thank you so much, Clark. If we
Sure. I think we should take questions from the audience. And I see that Mars, I'm not sure if that's the right way to pronounce your name. You have a question. Can you come off mute?
Yes, hi there. Hi. Yes, it's
Hey.
Maz. I go by Oz to make it easier on you.
Ah.
But Maz is my Israeli name.
Nice to
Anyway,
meet
I'm quite new to the investment world, but have some of my own experience over the past 5 years or so, mostly with the smaller multifamilies, 3 flats and some 6 flats. And now getting into the game a little bit deeper, I wanted to ask about unique products and hard money loans instead of investment funds when we raise money for syndications, for down payments and such. I wasn't on that first part of the conversation where you may have touched that point, but are there products like that nowadays available to complete 20% down
Talking
payment?
about kind of financing products that would kind of be a gap fund for your earnest money deposit in order to get into a deal under contract.
More on the down payment side. Say we come up with 10% from investors, and then we'd like to get the deal, and it's lucrative enough to support instead of rushing after another. It's the other 10% for that matter. Getting it on either bridge loan or a hard money loan from private lenders.
What the last 24 months, 36 months have taught us is, being very careful about leverage. I'm not going to come and say that, you're not going to be able to find a group that's going to give you 90% LTV. But there are a lot less people that are doing those loans right now because of the fact that they gave so many people 90% LTV in 2021, and now that's 130% LTV. And those loans are completely upside down. And even if they take the property and try to sell it, they're going to lose. They have made a realized loss. Now,
Yeah, so both sides are both sides are losing. But no, I'm not talking about 90%. I'm talking about the 20% on the side. After the the main loan, 25% down that they require, or 20% in my some cases that we may find for a strong deal. Instead of giving the 10% to an investor, paying them out of cash flow about 10% plus appreciation down the road, getting a hard money loan from a private lender just on those 10% separately, if that makes sense.
No, it makes sense. I mean, I think what you're thinking about is a hard money loan that would do, like a mezzanine deal to get you behind an agency or a bank loan at 65 or something, or at 80 to get you up to 10%. So you don't have to raise half the amount of equity from other limited partners. Is that more or less correct?
Exactly.
Yeah.
That's exactly accurate. I mean, either for the time being until we reopen it, or even if it's for 2 years, then just not to rush. If we have a good deal on the table and we want to close it and we're coming to the end, at that stage, sometimes it gets harder to get the last, even if it's 5% for that matter.
That absolutely exists. But it's easier to communicate to these individuals that are providing, a large slug of the equity, is for them to hopefully be able to structure it as pref instead of mezz. And the reason why I say that is because a mezzanine loan, mezz, they function very similarly. But the only difference is that mezz is like a secondary loan that has a secondary lien, and many of the primary lenders, the bank, the agency, the whatever, don't like having secondary liens, right? If you do pref,
Right.
they don't have a secondary lien because they're effectively investing
The
into
partners,
your operating agreement.
they become partner lenders, so to say,
That's
right?
right.
I like
So
that term,
the
lender
word he
partners.
asked for is like, hey, I need $1 million in pref. That is certainly possible, and we see that very often. More so now, we do that to structure people that are underwater in their bridge loans, because there's some more detail I can give you guys if you want to hear it. But there's about $7 billion worth of loans. Well, actually, $61 billion worth of loans that were surveyed. Of those $61 billion worth of loans, the average refinance pay down was about 11%. So people, what I'm meaning is that when they refinance out of their bridge loan, they can't get a cash out refi. They can't get a refinance that allows them to go in and say that, they can do it cash neutral, where they don't have to bring any money. In these scenarios where they were over leveraged in bridge loans, or even developers that were over leveraged in their development loans, they need, because the values of the properties are lower, they need to inject capital into their refinances in order to refinance the asset. People do that via capital calls. That's the kind of keyword, the buzzword. Or what you can do is you can structure pref equity in the form of being a supplement to the capital call, right? So you effectively will find that extra 10%, of the stack of what you were initially going to have to re-raise again, by filling it with preferred equity, to your point.
Okay. And for that matter, do you have lenders that are effectively giving stuff like that around Chicago?
Yeah, absolutely.
That would be the next one.
Once you get,
Sounds like you have a deal.
Oh yeah. I'm working on a very strong deal that's coming from a very good developer friend of mine. But that's it. If you want me to bring the details, I'm more than happy to. Working on a couple of them actually, but if we can find ways to finance or
what
offer
I
it.
would say is that it's in the pref world much easier to find credible people to provide pref for you once you start going for $1 million or more. And the reason why I say that is that there are a lot of people out there that, like, oh, I need $500,000. They'll do it for you, but, there's also a chance that you're partnering with someone who could be, maybe predatory in nature. I'm not saying that any person that provides pref and less than $1 million checks is predatory. There's predatory people that provide $10 million pref checks.
Yeah.
But what you're looking for in a partner, because they are a partner, that
Most def.
is someone who is sophisticated, institutional, credible, because they're bringing in a substantial amount of money into your investment, and you want them to be a good partner for you. And it's easier to be able to do that and value their credibility if they have a track record of investing. They have references for people they've done pref behind. They have a competent website that has about me profiles and stuff. If it's a guy that you're meeting on a forum that says, "Hey, I can give you 150K at a 10% rate," not saying he's not credible, but I'm saying that the risk is higher for them being not credible. In that sense.
Yes, but if you're saying pretty much to get to the credible ones, we need to ask for $1 million at least.
I would say
That's even a better problem for me to handle, because I got more deals in the pipeline that are waiting for funding, so to say. If I have that problem solved, or not relying solely on investors that I'm trying to bring both from the group and out from Israel, that'll give me a really good leeway, I would say. So if we can discuss that sometime soon separately and start rolling the ball, I would really like to attack that. At the same time, those are all potentially LPs on syndication deals. In other words, if they say, "Okay, I'll give you $1 million," and now I can actually offer them a partnership, an LP on that deal, would that be something that would be even more attractive in their eyes?
So what you're bringing up is a participation program, and that is difficult to get traction on, or a JV below, I would say, 10 million. Once you start getting into 10 million, then you have people that are more and more interested in participation, because typically that participation takes longer to realize. And the people that do participation, make safe, larger bets.
Thank you, Cohen, for your questions. Let's give other people opportunity to ask, because we are behind.
Yes, we can of
Thank
course
you so
elaborate
much.
further separately. If there's something
Clark,
to ask
while
on
we are
that one.
waiting for the next question,
Thank you.
can you put your contact in the chat so that people can reach out to you if they have further questions?
I kind of put it in the chat, so let me
Okay.
show you. Clark, you can add whatever might be missing to what I'm posting. Does anyone else have any question for Clark before we wrap up? Come off mute, throw your hands in the air. Yes, no, you were just blown away by the wealth of his knowledge. All right.
Okay.
While you guys are thinking, I might want to share. Oh, wait, hold on. Never mind.
Oh, we have two people. Okay.
Yep. All right. So we'll take Stephen, and then Bernice, and then I'll wrap up.
Hey, Clark. I just sort of wanted to maybe get your opinion on my situation. I don't have that much like liquidity. In fact, it'd probably be like a very low amount if you look at like my cost of living, right, situation. It's not that great of a situation, but I do have about 1.2 million in assets and background, and being able to like be part of the management over like the last 20 years of a family portfolio and a larger scale property in the Dallas market, a 256 unit building that I had to like spend 2 separate times, where management companies let the occupancy fall and let the property fall, and under sort of my expertise in getting there from what I've done in California, because I know the California market and the Texas market. How seriously is someone on like your end of a deal taking someone like myself if I'm not coming to the deal with the liquidity, but I have just like partners that do have it?
I think that from your perspective, I would, if you have the experience piece in that case study, that you can go and say like, hey, here was my, income and revenue for this property in this year, and the property management brought it down, and then I self-managed it back up to here, and then put it into third-party management, and then it went back down, and then I took over and self-managed it, went back up to here, and like the reason why the property recovered was because of you, or something similar to that. You have a case study of experience, right? Check that box. You're assembling an A team, and you're one member of the A team, and the other two members of your team maybe have a larger balance sheet or larger liquidity. Then I would say, yeah, I mean, you absolutely could probably get a deal done. So I mean, that's what it's all about, is surrounding yourself with people that each provide their own value. Maybe one person doesn't have really good net worth, liquidity, or experience, but they have an excellent network and they can raise a ton of money very quickly, with very minimal effort.
And
But
am I being unrealistic to try to play in like the $100 million type of markets if the last experience was like on the sale of the 256 unit was in the $30 million range?
I would say that, how long did you manage that asset?
About 12 years
When did you sell it?
in 2020, right? Surprisingly, like a couple months into COVID.
I still would probably, I think the $100 million range is a stretch, because, and the only reason why I say that is because everybody that's on the key principal team needs to invest, some level of, dollar amount. Okay. And if you're buying a $100 million asset and you get a 75% loan, then you guys are raising $25 million. And typically you want the key principal equity to be, maybe 5% of that. So all of a sudden that 5% goes from being, 250K for a smaller deal to, $2.5 million on a larger deal. Right. And so even if you guys are doing, you know, if you have two other partners that are, heavily liquid, I personally think that you're probably the strongest element to a team that's buying a $10 million deal than a team that's buying a $100 million deal. And I do a few of those $10 million deals, get those under your belt, add to your experience, continue doing it. And then, I mean, I think sooner than later, you'll find yourself doing much larger deals, you know? But if you're trying to get something done, I would focus in the, 10 range.
Cool. Thank you. Appreciate you.
Yeah, no problem.
Awesome, thank you. Bernice, did you still have a question?
Yes, my question is, could you help us to get the money that we have tied up in other properties? They're single family, we have, maybe 8 to 900,000 tied up, and we want to start using that for multifamily assets. And I was wondering if you could help us with that. That's my first question. Second question is, we're involved in some construction projects with other partners, and it looks like they're having some difficulty getting funded. And I was wondering if you could give us some assistance in that, because it's a new construction of multiple townhouses.
Absolutely. So to answer the first part of your question, what I would recommend doing, people come to me often and say, hey, I have, 12 homes or 15 homes or 20 homes, and I want to pull out the equity of these homes and, you know, and use that to buy something. And I go, yeah, no problem. Absolutely. You know, I'll get you, you know, there are products. There is actually more products today than there were, 2 years ago that are all about the single family rental portfolio. But here's what I run into. Those products want to get all 15 of those homes and keep them in the same portfolio for 5, 7, or 10 years. And often, single family operators like to have flexibility, And so I would say that you're probably better off, unless you're okay with holding all of them together for the next 5, 7, 10 years, just going to your local mortgage broker and refinancing, probably at a higher LTV, probably at a better rate than what some of these other options are going to give you. But keep in mind, the options that I could provide for you are longer term in nature, they're full term interest only, and they're non-recourse.
Say that again?
Non-recourse. Recourse is if you default on the loan, and say you defaulted on $1 million loan, and they took the property from you and they sold it and only made $750,000 from the sale. The recourse provision would say that they're going to come after you personally for the remaining $250,000 to make themselves whole. Non-recourse, you just hand the keys and walk away. That's the key difference.
Okay.
Hey, Bernice, I did periodically post Clark's information in the chat. So feel free to reach out via email to him if you have more questions or if you have any follow-up issues. Okay. Aaron, is this going to be quick? We do need to wrap up.
Thank you.
It probably wouldn't be.
Okay. Why don't you post the question in the WhatsApp group, and then we'll get it across to Clark, we'll get his answer, and then we'll post it for everyone to benefit from.
Okay. Actually, I wrote this number down. It's kind of crazy, and I don't have much information. So there's not a lot of solid ground in this question. So it'll be better a little later. Maybe
Okay.
I'm supposed to meet with this guy in a couple of days.
All right.
Okay.
That
Thanks.
sounds good. Clark, I can't thank you enough for coming and sharing your wealth of knowledge. Thank you so much.
Absolutely. Thanks for
Thank
the
you so
opportunity.
much, Clark, for honoring us, for sharing your wealth of experience. It was fantastic.
These are a lot of fun to do. And Bibi is a very cherished person in our company. I definitely would give her my stamp of approval of somebody that is a credible person to work with. She gets things done, and it's impressive. So with that being said, thank you guys very much. I am going to sign off here. But if you have any questions, I believe my contact information's in there, and we can work to get them answered. Okay.
Awesome. Thank you, Clark.
Absolutely. Thank you, guys. Have a great day or evening.
Have a good night. Awesome. All right, guys. So as I said earlier, for those who were not here at the beginning, next week is another asset management Zoom. There is a little switch up in the schedule for this month. So next week is not an activation Zoom, it is asset management. And we are going to be talking about leveraging due diligence for effective multifamily asset management. I'll stop the share very briefly. And then I believe the week following would be is when Michael Blanc is coming. That isn't, yeah, that's an activation Zoom. So thank you guys for coming. It was such a pleasure. I hope you guys learned a ton from this. If you have questions that you didn't ask or it didn't come up, you didn't think about it during the Zoom, feel free to throw it into the WhatsApp group. Folks who were not able to come will definitely learn from this. And we will see you next week.
Thank you all.
I'm just trying to get to my beats. Here we go.